Let's discuss the execution of portfolio decisions, monitoring and rebalancing. This is an important discussion. We will see what are the challenges and issues related with portfolio executions when it comes to when we have planned, develop a portfolio and we are going to implement it. What could be the possible issues we could have? The biggest issue is market microstructure. Micro, as we know, is in the smaller, in the individualized way, and macro is the bigger picture of this. Same way, we have to see the definition of market and order types, trade cost. We have to see and calculate the implementation shortfalls, and we have to analyze the trader and tactic types. These all are the areas which is when you are going to implement your portfolio is going to create a challenge for you. Let's discuss one by one about each area. We'll start our discussion with the market orders. Immediate execution at the best available market price will be a good strategy. If the order cannot be completed, filled in one trade, it is filed by another traders at the next best possible prices. Same way in terms of execution, certainty is a very important factor. So emphasis on the speed of execution. So news in the market can be materialized efficiently and smartly. Price uncertainties should be avoided by exact execution price, because the exact price is not being known as of before the implementations. Sometimes we can limit the order to trade at the limit price or better. If not filed or before the specific time or date, limit order expires. Then see the execution uncertainties in terms of disadvantages, that if they go unfiled, only only partially filed, so the execution will be in danger. In terms of price certainty, a limit order emphasizes the price of the executions. We have quotas, quoted spreads, and the misquotes and mid-quotes. In terms of quoting, the first important thing is the bid. Bid is the price the dealer will pay for an asset. Ask is the price for which the dealer will sell it. This is the asking price. Then we have quoted spread. Quoted spread is the best ask price. For example, the best price, market prevailing or inside spread. For example, like if a current bid price is say $19.97 and the best price is $20.03, so then the quoted spread is the difference, that is 0.06. Mid quote is the average of the bid and ask. So from above, of course, like that I give you the example, is the mid price is 20, that is in the mid. Defined, let's talk about effective spread. What is effective spread? Is 2 times the deviation of an execution price from the midpoint of the market quote. That is your effective spread. It is of course a primary focus for the traders, and it captures price improvements and it gives you better measurements of the true cost of a round trip transaction. How we calculate the effective spread is effective spread for a buyer is 2 into execution price minus mid quote. For a seller it is 2 into mid quote minus the execution price. We can compare the both, and we can execute the price inside the market spread. In terms of security market structures, We have code-driven dealer markets, we have order-driven markets. These are 4 order-driven sub-markets we have hybrid markets as a combination. So in terms of code-driven, member of the public trade, where dealers, market deal makers who provide liquidity and they establish the prices. What is the advantage of this is it helps market continuity by buying and selling from inventory. Also it provides bridging liquidity in naturally liquid bond market. This is one of the advantage. When we use order driven markets, investor can transact with each other without market makers, so they are more open to each other. Advantage is price can be discovered easily, mechanical rules match counterparties, public order determines the liquidities, so there may be no dealer willing to carry an inventory of a security. Liquidity may be poor in this case. When it comes to order-driven sub-markets, electronic crossing markets, networks in which we can buy and sell orders at a specific points in time. This is we call as POSIT system. Mostly institutional investors, that is the 4th market, trade filed anonymously. The trading cost and commissions are low, poor liquidity, unknown counterparties, identifications, and of course there is no previous market prices can be discovered. In terms of auction markets, we can order competes for execution to provide price discovery. It is a symptom of a continuous market, and we can batch the markets open of say for example Tokyo after a midday break, open and close of exchanges where orders are aggregated for a single execution price. In terms of automated auction markets, they are computer based and there are certain electronic rules set for it, electronic communication networks. The advantage is of course the anonymity, you need to know to disclose yourself. Price discovery is easy and increased liquidity in terms of narrow spreads. Brokered markets, we have brokerage markets or brokered markets. There are upstairs markets where transactions are executed through a surge brokerage mechanism away from the trading floors. What is the use of? They have a larger block to sell or illiquid. Anonymity is important. Relatively smaller or developing markets. Hyper markets can be a combination of the previous markets in this relation. The role of broker is really important. Brokers are paid commission to act as an agent for the traders. Brokers, they present order to the market, they find opposite side of the trade. They provide market intelligence to investors so investors can take effective decisions. They provide discretion and anonymity which helps them. They provide leverage, cash management and safekeeping services through which induce investor to rely on the brokers. Dealer has the adversarial role, relationship with traders since they manage their own accounts. Dealer goal is sell or buy at the highest ask, lowest bid price to maximize bid-ask spread, the difference. Dealer provide information to traders, can experience adverse selection when they trade with traders who are more informed than, so it can be creating a bit challenging atmosphere between the dealers. In terms of market quality, there are certain criteria that we have to keep in mind. Starting with the security market should be judged on the basis of its liquidity, transparency and surety of completion. Then we have signs of high liquidity and market equality, that is more based on lower quoted spread, lower effective spread, and higher bid and ask prices can be observed in terms of high volumes. In terms of market quality and liquidity, there could be different situations. One situation is the tight situation, where we have low bid ask spread, we have deep abundance of traders, and we have resilient, that is diversity of opinion, information, liquidity, needs quickly correct divergences for intrinsic values in terms of market, convenient and attractive to the investments. We have to create the transparency. Participants can quickly and inexpensively view information on quotes and trades, and it should have low transparency, because low transparency generally leads to low integrity. So if you have a high level of transparency, information flow, people are taking effective decisions, it is creating a high integrity for the dealer and the brokers.